What is happening is that individual stocks are becoming very volatile, but they're flying about in different directions and leaving the index relatively calm on the surface. But these cross currents are quite violent beneath the surface.
Do you think that's going to change? Do you think maybe you're sort of hinting? Do you think that there may be some more troubled waters ahead?
Well, I've got to be honest, I've never seen this before.
Hi, welcome to another Super Macro podcast. My name's Elvis. I want to discuss a couple of things today. Firstly, the yield curve flattening, what it really means. And secondly, equity markets. They've done a lot of volatility in the last couple of weeks, but haven't really moved very much. What's the outlook? Jonny, welcome back.
Hi, Elvis.
As sitting opposite me, Jonny Matthews, veteran hedge fund manager and the author of Super Macro, the heart and soul of what we do here today.
Yep. How are you, Elf?
Yeah, not bad. You know the two topics I want to discuss with you, but the first one I want to go through with you is dollar yen.
Yes.
Can the Bank of Japan continue to act in the way that they have done, acting as, in terms of normalising, as slow as anything we've ever seen before, or is something going to break?
That's a good question. And I think what you've got in mind is either inflation or the exchange rate, right?
Yeah.
Yeah. And if we look up chart one, this is dollar yen in the post-Plaza period, the Plaza Accord.
Sort of broken out there, damn it, isn't it?
Yeah, well, it is at a 40-year high. This is the highest since the aftermath of the Plaza Accord in 1985. And just to refresh your memory, that was when the G5 group of advanced economies... They decided the dollar was going to go lower. Well, it was the US request to get the dollar lower. And as a result, the yen rallied very, very strongly. And it ushered in the lost decade in Japan. So, well, actually, it was more like two decades. Yeah. So Japan, was fighting off deflation throughout that period. Their equity market collapsed. Their property market collapsed. It was a really, really tough time for Japan.
They had a proper bubble bursting there, didn't they?
Yep. And then, they took steps, with the election of Abe in 2012.
Triple arrows.
Yeah, the 3 arrows policy, the reflationist agenda, and that's been continued now with the new Prime Minister, Takaishi. And now we have dollar yen, coming back to a 40-year high, meaning, in other words, the yen is extremely weak again. And just getting back to your question, can they...
Does it break?
Does it break? Well, let's put it this way. I think for Japan, which imports most of its energy needs, it was quite critical that either the oil price came back down again or the yen strengthened, because their energy costs were going through the roof.
Yeah, because all the subsidies they were giving as well.
Well, that's the thing. Yeah. The government was providing very, very generous subsidies to cap the price of gasoline and to subsidise.
Which, as you mentioned in the note of the weekend, seems to have worked.
Well, it has worked now. So,
assuming that oil doesn't go back up to the highs we saw over the last couple of months.
Yeah, assuming it doesn't kick off again over there.
Yeah, obviously, that's no guarantee of that won't happen.
No, that's true. But... countries can't have a fixed exchange rate, an independent central bank policy,
right,
and free and open capital markets. Something has to give. So in Japan's case, they're trying to anchor the exchange rate. If you want to do that, you've got to allow the central bank to prevent the capital flight from the country by jacking up interest rates.
Which they're not going to do. Or you've got to have capital controls. So you either let the market decide the clearing price for the yen, or you do a lot of other things you don't want to do. So what's the answer?
What's the answer? Well, I think ultimately the Bank of Japan will normalise policy at a faster rate than they have been doing. But I do feel we're going to get some more intervention. I was looking at a chart today of listed exposures, listed future Japanese yen futures.
Right.
The speculative open interest in these yen futures contracts.
And they're pretty lopsided.
Well, they are a bit stretched. The speculators are jumping on this.
And the longer it goes on like this way, the more they're going to jump on it, I assume.
Yeah, so I think there's a good chance that the Japan finance minister, she'll direct the BOJ to buy the yen again. But there is only limited firepower. I think we discussed this previously.
Yes, I don't want to go too much into this, but you also, just something in the note that you mentioned, which I thought was quite important. This is the weekend note. You said that the composition of the Bank of Japan, the hawks, 2 hawks are going to be removed by this time next year. And is it Takeuchi, the Prime Minister, will probably put on a couple of doves.
Undoubtedly.
Doves who, what they call it, sorry, not doves, reflationists, which is, what another word for the same thing. Anyway, but that could let the Bank of Japan act at a tortoise pace, knowing they're not going to have it, the hawks are going to be gone within a year. 2 hawks are going to be gone within a year, rather.
That's right. So I think ultimately the yen will weaken and inflation will stay elevated in Japan and the BOJ will be behind the curve. But I'm not going to, have another go at dollar yen for the moment, because any day now, I just feel there's going to be...
They come in and move it 2 or 3 big figures. Yeah. It might well drift back up again or lower in yen terms, or get lower yen again, but it'll be painful.
It'll be painful if you're in too early.
Yeah, you're in too early. Okay, let's move on. Let's talk about rates.
Yeah.
The market's taken much of the hiking out that was previously priced. Take us through that. What are you seeing there? And why, more importantly?
Well, yeah, you're right. I mean, obviously with oil prices coming down, headline inflation will drop. So previously... if we go back to the start of the year, there were a couple of rate cuts priced in. And then once the war started and inflation picked up very dramatically, the market took those out and started pricing in rate hikes. Now, across the major central banks, the amount of hikes that were at one time priced has been pared right back.
But this is just, again, this is something you wrote about in the note. This is the headline that they're focusing on. This is not the core, which is probably more important, and the super core, which I'm sure you're going to come on to at some stage when you're talking about this. But tell us, why is the market just focusing on headline rate, which is just dominated by crude?
I think because in a way, potentially, we've just had a headline print that was above 4%.
Right.
So now with the oil price falling back, we know that inflation is going to be on a downward trajectory, which will buy the central banks some time to decide what they want to do. And we've had various ECB officials saying along the same lines that they can now take their time, and the Fed's going to do the same thing. But I think, Walsh at his first press conference did give it the hawkish big one.
Super hawkish compared to what the market thought it was going to be.
Yeah, I mean, he reiterated, and I'm going to quote here, the Fed's strong and unambiguous commitment to price stability.
It's not unambiguous. It's not an unambiguous statement, is it? It's actually spot on what someone would want to hear if they want them to be sensible.
Yeah, but
we know that probably won't happen.
Well, the market seemed to take them at their word, So we had that big sell-off in 2-year rates. In other words, the rate went up 13 basis points on the day, and the curve dramatically flattened.
Yeah.
And as a result of that, I think what were potentially quite consensus trades, like the curve steepening trade, like the dollar debasement trade, these kind of things that these were popular narratives at the start of this year. They've been
with some other trades as well, like Bitcoin. Bitcoin's probably a bit like last year, but maybe gold and silver, the precious metals trade.
Precious metals, and we can see it on chart 2. You can see the yield curve flattening. So that's the spread between the 10-year and the 2-year yield on the left side, which got out to about 72 basis points, and it dropped down to 25 basis points last week. And there, I've put on the blue line, we can see gold that got up to $5,300 an ounce or whatever. Yeah. And now it's struggling to hang on to the $4,000 mark.
So for now, we're saying that some of these speculative trades, the ones that don't yield anything, are going to be governed by the cost of money.
Yeah, possibly. But I'm still not convinced the Fed is going to be able to be that dovish, is going to be able to drag its feet. I think inflation is going to be high persistently. There is a core level of inflation. I mean, if we look at chart 3, and I think I showed this last week, but here's an updated version with the actual figures in. Last week I put in a forecast, but there you can see, core PCE inflation now up at 3.4%. Super core, which is PCE services inflation less housing, up at 3.9%, almost 4%.
Isn't that a measure the Fed want to forget now? They focused on it, but we don't like it anymore.
Well, he's still there.
Oh, that's Powell's. He's gone.
He's on his way out.
I'm not looking at that one. Trim mean, I think, is the one we're looking at now.
Well, yeah. So, but it doesn't matter, which measure you take. They're both elevated. They didn't get really below 2.5%. And they're both heading higher rapidly.
You don't see these turning south at any stage in the near term.
Not in the near term, no. I don't think so. I think
supply chains are still being squeezed, even though oil's flowing. It doesn't just literally. It's not binary, is it?
No, it's not. And right now, this idea that AI would boost productivity and hold inflation down. So far, we're just seeing the inflationary effects of increased AI adoption, demand for chips, the
and
prices
memory, DRAM, that sort of stuff. Yeah,
and we saw the price hike from Apple. Of course, shouldn't get too carried away with that. 20% price hike for Apple tablets and Macs and so on. It's a big price hike, but it's a small part of your average expenditure.
Yeah. Okay, that's fair enough.
I mean, how many times do you buy a new Mac? How frequently? Once every couple of years, maybe
3, 4, 5 years, maybe.
Yeah. So, but it's just indicative of the kind of trend in goods prices and services prices to an extent are more governed by wages.
Okay.
And I would say the jury is out for that. Of course, we got the payroll print coming up this week.
Big one, Thursday.
Yes, and I think people will be very, very closely focused on wage growth.
You said we talked about this. You said unemployment rate will be interesting as well. If that ticks down to 4.2, you think the bond market might not be able to take that nicely, or would sell off on that?
I do think so. I think the thing that the market is probably going to be most focused on is the unemployment rate, and it's expected to stay unchanged at 4.3%.
Average hourly earnings, which is supposed to be a more benign numbers coming out.
Yeah, average hourly earnings have
big number. Like, I'm assuming 0.4 or 0.5 in a month would be a big number.
Oh yes, yeah, but on a year-on-year basis, it has been slowing. But I think that's a lagged effect of the soft patch that we had in employment growth.
Yeah, that was last year.
Middle of last year. Yeah. So now we had a period of stability, and now it seems like the labour market is heating up. We just had 500,000 jobs created over the prior 3 months.
That's a decent clip.
It's a lot. And if we look at private sector payroll growth, it's grown at an average of 120,000 a month for the last 6 months.
It's pretty good. Bear in mind, there's no net migration. So you'll take it. Where are you getting these workers from?
Absolutely. The supply of workers has really dried up. As you say, no net migration to the US, aging boomers who are retiring. So the supply of labour just is nothing like it was.
Right.
And so people are getting hired. It is putting downward pressure on the unemployment rate. And it could, I'm not making a prediction here, but it could just drop to 4.2% in the next month or so.
This is an opinion, isn't it? I take it. This is not investment advice.
Absolutely. Everything I say is just my opinions, not investment advice at all.
Do you want to flip on to equities? Do you want to talk a little bit about equities?
Yeah. Okay. Well, let's park the rates market to one side for now, and let's talk about my concerns for the equity market, because
we're looking at chart 4
let's just look at chart 4.
Yeah.
As you said at the start of this, the equity market's gone nowhere for the last 2 months. It's just been a lot of volatility and a lot of chopping around, but beneath the surface,
huge moves.
Yeah. And it's kind of interesting if you look at this chart. The red line's the Russell Growth Index, the blue line's the Russell Value, and the Growth Index has dropped quite a bit in the last few weeks. Now, That's not.
That's hyper. That's not. Well, it's not the.
Well, it's a
Russell, but-
bunch of things. So
Yeah.
we'll move on to those in a minute. But the point I'm making is that the previous times when the Russell Growth Index took a nosedive were periods of stress for the market, where the growth index dropped, for example. During the build up to this
So you
Middle East
reprice the
conflict.
risky. You reprice the riskier stocks in
Yeah,
in risk
yeah,
of,
and the same thing happened during the Liberation Day announcement.
Yeah.
Last year. But what is interesting in this most recent period of the last few weeks is that the Russell Value Index has continued going up. So there is this rotation.
It's a
this
rotation
churn.
rather than getting out of positions. They want to, as soon as they sell something, they're buying something else. So we're just rotating from growth to value.
Yes.
I want to be long. What do I want to be long
On the
of?
face of it, if you just look at this, that's what you would say is going on. They're rotating from one sector to another, out of the high growth sectors into the more value oriented sectors. But it's not just that. There are other rotations going on. If you look at chart 5.
Okay, let me get there.
So this is really
Wow, yeah.
the
See that one?
the makers of chips versus the buyers of chips, if you like. So we've got the Philly Semiconductor Index, the SOX index there in blue, and these are all set to be 100 in June 2023. So you can see the Philly Semiconductor Index has gone through the roof, and that's kind of keeping pace with the increased earnings expectations of these companies. Chip prices are going up. There is insatiable demand. They cannot supply these
And the
chips fast
hyperscalers
enough.
don't seem to be slowing down, do they? They just continually want to build bigger and better than the next guy.
They're the ones that are spending all the money. So
Yeah,
they're the
yeah.
ones buying all these chips and buying all these air conditioning systems and power generation systems and everything else. But what is interesting is that these two cohorts, these two different kind of branches of the tech sector, did move in tandem up until the last few weeks, and then we've just seen the semis just going through the roof.
These are dramatic moves.
Yeah, and the hyperscalers coming under some pressure, largely due to their enormous capex plans that we discussed previously.
Yes.
And it doesn't stop there. I mean, I don't. Okay, I haven't got the chart here, but if you look at within the semiconductors, it's the makers of the standard, the DRAM
chips that
are really flying at the moment.
They can't get them out. They can't produce them quick enough.
Produce them quick enough. Although the South Korean guys have announced new plants to manufacture them today, and that's often marks the kind of the
because
top of the cycle.
in a something that's mass produced, even if there's not much of it around now, once they start building new plants to make them, then you cover that demand.
Well, that's what typically happens. They overinvest at the peak of the cycle, and then all of a sudden, the demand is satisfied.
Sounds like miners. Sounds like all the miners.
Yeah, it's like the same kind of behaviour as the miners.
Let's move on to chart 6. This is the one that I found very interesting. I think you did as well.
Yes, I had. Now I've looked at this in some detail. I do find it fascinating.
You need to explain to us what the constituent vol index is.
Yeah. So I think most people know what the VIX index is. Yeah. It's the equivalent of a 30-day variance swap on
the index,
the S&P 500.
Yeah.
So it's a measure of 30-day implied volatility. We've got the same kind of implied volatility measure for the top 80 stocks of the S&P 500.
Right. Okay.
That's what it is. It's the top 80 stocks by market cap, which is about 2/3 of the index market cap.
Right.
Those top 80, if you're measuring those, you've pretty much got the whole of the index, really. And if you look at the implied volatility of these top 80 stocks, it has moved up and up and up and up recently. I mean, it is extremely high relative to the level of the VIX. That spread between average constituent vol and the VIX is as wide as it's ever been.
So the currents below the surface are enormous, but the surface looks calm.
Yeah, that's right. There are these very vicious cross currents. There is this churn going on under the surface. What is happening is that individual stocks are becoming very volatile, but they're flying about in different directions and leaving the index relatively calm on the surface, but these cross currents are quite violent
And
beneath the surface.
Do you think that's going to change? Do you think maybe we're sort of hinting? Do you think that there may be some more troubled waters ahead?
Well, I've got to be honest. I've never seen this before, and I have traded the dispersion strategy, which is what this is, where you own the basket, the constituent stocks. You own options on these constituent stocks, and you're short options on the index. It's what we call a dispersion trade, and you want the stocks to be completely uncorrelated as they are at the moment. That's how you make money. And I was doing this trade 30 years ago. Over the years, I have run dispersion trades, and never in my life have I seen it like this.
Yeah, okay.
Never. So what does it mean? To be honest with you, I don't know. But I think it's showing you that there are some quite violent cross currents churning around beneath the surface.
So, Jonny, headwinds coming potentially. Is the supply of equity, or the reasonably big increase in supply of equity, part of those headwinds?
Well, yeah, I think it is still a headwind.
You discussed this last week. I know we talked about it last week.
Yeah. Obviously, OpenAI postponed their IPO, or delayed it till probably next year. But even so, you're still looking, even without them, it's going to be 350 billion of extra supply coming this year, assuming the others.
So it's going to take investment from elsewhere, if to supply that market.
Yeah, I mean, we had obviously we've had SpaceX already. We've got, I think it's Alphabet that have done the capital raise as well, the 85 billion or whatever it was. Meta looks like raising capital as well, and then you've got not only have you got the share issuance as well, you've got the corporate bond issuance that's taking place as well. So there are enormous amounts of capital being raised from the market, and this supply of equity, I think, is going to weigh on the market. I'm not saying we're due for a collapse, but I think it's going to be, heavy going for the next few months.
Come on. So we haven't had what I call a proper sell-off.
No, I'm not sure that these conditions represent the kind of conditions that would lead to a massive sell-off. I think the difference this time, and I know it's always dangerous to say this time is different, but both the household sector and the corporate sector are far less leveraged.
That brings me on to the next chart that you've got here.
Yeah. I'm not. I'll show that the household sector here. I mean, this is quite staggering. What is it? Chart number 7.
Chart number 7.
Okay, so on that chart, and you can see what a difference it is between now and the run up to the housing crisis, and which led to the greatest financial collapse of a generation.
Household debt to disposable income. Look at that red line coming into the 07, 08.
Oh yeah. It was.
Affordability was getting crushed.
Yeah. Yes, but people. I mean, it didn't really matter. People were just taking out mortgages, leveraging themselves up over and over, and you can see that average household debt to disposable income above 100% at the time. Well, now households have, for the last 15 years on balance, been paying down. They're still paying their mortgage. Bit by bit, they're chipping away at the principal. So the total stock of debt has come down relative to their income. But also they've refinanced into
much lower rates, courtesy of QE.
So it's much more easily serviceable. And, the debt service ratio, that is the total debt payments, that actually includes credit cards, mortgages, car finance loans, all of it, as a ratio to disposable income, or percentage of disposable income rather. It's much, much lower now than it has been for decades.
The consumer on those charts looks pretty good.
So
pretty good shape
I think
to
the
me.
household sector is in good shape.
Pretty good shape.
And so I don't think we're at a point where there's going to be some kind of massive financial crisis, but the equity market could have a bit of a setback.
Could stumble.
Could find it a lot harder to make progress from here.
Okay, final question, unless you want to talk about it. Any thoughts of what you got on, or are you pretty flat at the moment?
I am pretty flat. You know, I stopped out. I was short of treasuries.
Right.
Got stopped out. But, you know, I'm not going to fight that trend. You know,
That's probably the most important part of trading, isn't it? To know when you've got to stop yourself out, sit back, wait, and then get involved.
You know, I think you can't get it right all the time. In fact, you know, you've only got to get it right just a little more than half the time. But the most important thing is to cut the losses. And
because you can run the winners then.
You can run the winners. And my thinking was that the 10-year would break through 4.5%, the 30-year would get through 5%. Both have tried on numerous occasions.
But you did make the point that they were pretty solid ceilings for the moment. Doesn't mean they won't go through there, but for the moment, it's the impetus is not there.
Ultimately, I think they will. And what I will do, I think, you know, ahead of this week's payroll print is probably, you know, buy some more options.
Options cheap enough to...
Yeah, they are. They're incredibly cheap. So, you know, I think I will play it through options again in the run-up to this. And for the equity market, I just, you know, I want to see what happens. I've got very, very short, you know, I've been playing it with short-dated puts and put spreads and taking profit when I get the opportunity.
Yeah, that's the important thing, because it doesn't last for long.
Not in the equity market. As you say, you know, the buy the dip crowd seem to win out at the moment.
Maybe it's just it's a fader rally via these options. Maybe that's the way to play it. Maybe, again, that's an opinion, not
no, it's certainly not investment advice. But I think, you know, I think the equity market is gonna continue being quite choppy without the sort of upside that I was kind of optimistic about at the start of this year.
Yeah. Okay. So tell me, where can anybody read in depth what you're thinking?
So
get hold of you?
Yep. So super-macro.com, that's the website. Have a look at that. You can sign up, get a free 30-day trial. I write a daily macro and finance note. You're welcome to try it out for 30 days for free. Then it's £50 a month. And the weekend version is a more in-depth, you know, macro summary from the major globe regions, and a more detailed analysis of what's going on in the market and what I think is going to happen.
Thank you, Jonny.
Thank you, Elvis.